live from the news desk. We have an 11th-hour ceasefire in the Persian Gulf that is sending global markets absolutely skyrocketing, while oil plunges and honestly leaves the rest of the world holding its breath. Plus, we're looking at how airlines are, well, dodging the energy crisis by acting like sovereign nations.
Right.
And the massive domestic infrastructure moves that are quietly insulating economies from global shockwaves. Today is 09 April 2026.
And we really are tracking a rapidly developing and frankly deeply contradictory global situation today.
Yeah, contradictory is the word.
Exactly, because the financial markets are reacting to a breaking headline regarding a ceasefire, but the physical reality on the ground remains highly volatile. So to actually understand what's happening today, we can't just look at the stock ticker.
Right, you can't just look at the green arrows.
No, you really need to synthesize the military movements in the Middle East, the underlying economic data, and these surprising corporate earnings reports that are painting a very fractured picture of the global economy right now.
And that is exactly our mission for this deep dive.
Yeah.
Our goal for you today is to cut through the breaking news chaos. We are going to impartially report the facts surrounding this sudden U.S.-Iran ceasefire, analyze the mechanics behind this explosive market reaction, and track how these geopolitical shockwaves are forcing both countries and corporations to rapidly rewrite their survival strategies.
Because right now, the narrative on the trading floor is fundamentally disconnected from the physical reality in the Strait of Hormuz.
Absolutely. So let's get right into our lead story. Just 88 minutes before a self-imposed deadline, President Donald Trump announced a 2-week ceasefire with Iran.
88 minutes. It was that close.
Yeah, right down to the wire. And the core condition of this agreement is the, quote, complete, immediate, and safe opening of the Strait of Hormuz.
And the market's reaction to that specific phrase was just instantaneous. We saw a massive, almost unprecedented relief rally across the board.
Unprecedented is right. I mean, the numbers are just staggering. The Dow Jones jumped 1,325 points,
Wow.
which is a 2.85% gain. That marks its best single day since April 2025. And the S&P 500 gained 2.4%, while the Nasdaq surged 3.5%.
But the most critical data point for the broader global economy here is oil.
Right. West Texas Intermediate, or WTI, just plummeted 16.6% in a single session. It dropped all the way down to $94.17 several. And Brent crude dropped to $91.68.
Which is, well, it's a violent correction from those recent peaks we saw above $119 a barrel when the war concerns were really at their absolute highest.
Okay, let's unpack this because I need to play the skeptic for a second. Looking at these soaring stock charts feels completely paradoxical. Missiles have been flying since February.
Right.
At least 16 merchant ships have been damaged. 7 massive vessels have been completely abandoned at sea. Are Wall Street investors essentially just cheering that the fire alarm has been temporarily turned off, while completely ignoring the fact that the room is still actively filling with smoke?
What's fascinating here is that that's actually a perfect way to frame it. It really comes down to the mechanics of how modern markets function. Financial markets, especially when they're driven by algorithmic trading models, are fundamentally forward-looking.
Okay.
But during a crisis, those models are forced to price in the absolute worst-case scenario. And in this instance, the unquantifiable existential threat was a prolonged total blockade of the world's most important oil artery.
Just a complete chokehold.
Exactly, escalating into a massive, uncontained regional war.
Basically, a total shutdown of the global energy supply chain.
Right. And it's incredibly difficult for an algorithm to price in infinite disruption. So the moment a temporary 2-week truce is announced, that worst-case uncertainty is mathematically removed from the pricing models.
So it's not even human emotion.
Not entirely, no.
Yeah.
That massive 16.6% drop in oil isn't necessarily human traders feeling suddenly optimistic. It's the automated unwinding of futures contracts that had a massive fear premium already baked into them.
Oh.
But to your point about the smoke in the room, this relief rally leaves the long-term structural risks entirely unresolved.
And that reality is glaring when we look at the physical infrastructure on the ground. Because the algorithmic models might be, ignoring the smoke, but the physical pipelines simply cannot.
No, they can't.
The markets are trading on this promise of open shipping lanes, but the facts show that violence is actually continuing despite the ceasefire announcement.
Yeah, the situation on the ground remains incredibly kinetic right now.
Just look at the reports from today. Saudi Arabia's key east-west oil pipeline was just hit by a drone.
Which is a huge detail.
Right, and we need to understand why that specific target matters so much. That pipeline exists specifically to carry oil from the Persian Gulf across the country to the Red Sea. Its entire structural purpose is to bypass the Strait of Hormuz.
Exactly.
If the backup plan is getting hit by drones, the risk is clearly not gone. We're also seeing reports of explosions and strikes in Kuwait, the United Arab Emirates, and within Iran itself.
And the diplomatic temperature is just as volatile as the physical one. President Trump has threatened an immediate, no exemptions 50% tariff on any country that supplies military weapons to Iran.
Meanwhile, we have high-level talks slated for Friday in Islamabad, Pakistan, with U.S. Vice President J.D. Vance expected to lead the American delegation to try and formalize this truce.
Right.
So how do we actually reconcile this? We have a formal ceasefire announcement from Washington, but ongoing drone strikes on major Saudi pipelines? How does the Strait of Hormuz mechanically reopen under these conditions?
Well, it doesn't happen quickly. And that is the defining tension right now. You can't just flip a switch and expect global shipping conglomerates to immediately send multi-million-dollar vessels back into an active war zone.
Yeah, I'd imagine the insurance alone is astronomical.
Oh, absolutely. If we look at the mechanics of the proposed peace, Iranian Foreign Minister Arachi stated that safe passage through the strait will be possible, but, and this is the key phrase, it will be coordinated with Iran's armed forces and will depend on technical limitations.
Wait, so commercial vessels are supposed to operate under the direct military oversight of the exact same forces that were just recently targeting them?
Precisely. And this is where the financial market's optimism hits the brick wall of reality. An insurance underwriter in London does not care about a stock market rally.
No, they care about whole risk.
Exactly. The physical risk to maritime traffic is still exceptionally high. You have proxy groups, active drone warfare, heavily armed navies, and damaged maritime infrastructure, all occupying a very narrow, crowded geographic space.
So if maritime insurers are refusing to send ships into the strait, oil prices remain a massive geopolitical wildcard. But this brings us to a fascinating contradiction in the corporate sector.
It really does.
If fuel prices have been swinging wildly since February, how is an airline a business fundamentally dependent on jet fuel reporting massive record profits today?
This is one of the most revealing data points in the sources today, and honestly, it serves as a masterclass in corporate resilience.
We're looking at Delta Airlines' newly released March quarter 2026 earnings. And the numbers are, frankly, astonishing given the global energy crisis.
They really are.
Delta reported a record $14.2 billion in revenue. That's up 9.4% year over year. And their overall earnings are 40% higher than they were last year.
I mean, for any airline, jet fuel is traditionally one of the largest and most volatile operating expenses.
Oh, without a doubt.
To post a 40% earnings increase during an international oil spike means they have fundamentally decoupled themselves from the broader market chaos.
Here's where it gets really interesting, because the data shows us exactly how they did it. Having your own refinery during a global oil crisis is basically like owning the cow when the price of milk skyrockets.
That is a great analogy.
Delta literally owns an oil refinery. Their wholly owned Trainer refinery, which is operated by Monroe Energy in Pennsylvania, effectively offset the massive fuel spike we saw in the first quarter. This physical asset provided a hedge that is projected to yield a $300 million benefit for the June quarter alone. Does this physical hedge make Delta uniquely insulated compared to its competitors?
It really does. Most airlines try to manage risk with financial hedges, buying futures contracts to lock in a price.
Right.
Delta utilizes a physical hedge. They actually refine their own product.
Right. Usually an airline is just sitting at the bottom of the waterfall, holding a bucket and hoping the cost of fuel doesn't skyrocket by the time it reaches them through the global supply chain.
Exactly.
But Delta essentially bought the river. They were refining their own jet fuel, so when the middlemen panic and global prices spike due to a geopolitical crisis, Delta is completely insulated.
It provides an incredibly rare structural advantage. Now, we should note that the broader airline sector did experience a rally today based on the news of the oil price dropping.
Yeah, that makes sense.
United was up 12% and Carnival Cruise Lines jumped 13.7%.
But Delta isn't just riding a single-day news cycle. Their structural advantage with the refinery is what allows them to confidently project a $1 billion profit for the upcoming second quarter.
$1 billion in this climate.
Yeah. Delta's CEO, Ed Bastian, noted that they delivered these results despite, quote, operational disruptions across the industry. It's almost like Delta is operating its own foreign policy.
They really are.
They aren't just reacting to the global market. They have built a physical bunker against it.
And that concept of a physical bunker perfectly transitions us into the global macroeconomic picture, because Delta's surprising corporate resilience really mirrors a surprising resilience we're seeing in certain parts of the global economy.
Certain parts, yeah.
Right, but when we expand the lens, it becomes painfully clear that not every country has a refinery to fall back on.
We have two major, sharply contrasting economic reports out today that illustrate this divide perfectly. First, we have the International Monetary Fund's World Economic Outlook. The IMF forecasts resilient global growth at 3.3% for 2026. And they specifically attribute this growth to the United States, China, and a massive ongoing artificial intelligence investment boom.
But if you place that next to the World Bank's Europe and Central Asia economic update, the narrative shifts dramatically.
It's night and day. The World Bank warns that growth in Europe and Central Asia, the ECA region, is slowing down to 2.2%.
Wow.
And they explicitly tie this regional slowdown to the Middle East energy crisis, the slowing Russian economy, and the punishing reality of high energy import prices.
Yeah.
So are we looking at a tale of two economies here? Is the North American AI boom single-handedly carrying global GDP on its back, while traditional manufacturing and energy-dependent sectors in Europe are just getting crushed by the blockade in the Strait of Hormuz?
If we connect this to the bigger picture, that is exactly what the data suggests. We are witnessing a severe fragmentation of global growth.
Right.
The United States is currently insulated by a combination of domestic energy production and massive capital inflows surrounding tech and AI infrastructure.
The AI boom is doing a lot of heavy lifting.
It really is. When billions of dollars are being poured into building data centers, it masks vulnerabilities in other sectors. Europe and Central Asia, however, do not have that same tech-driven capital expenditure.
And they import their energy.
Exactly. They are highly exposed to external energy shocks. When natural gas and oil prices spike, their manufacturing base simply grinds to a halt.
But even that American tech optimism have a massive caveat attached to it, doesn't it?
It absolutely does. The IMF report included a very specific warning about the AI boom. They noted that if there is a sudden reassessment of AI productivity, meaning if this technology doesn't deliver the immediate economic gains and efficiencies that the stock market is aggressively pricing in right now, it could trigger major market corrections.
So the entire global economy is essentially balancing on a razor's edge. You have intense tech optimism on one side propping up the numbers, and extreme geopolitical trade tensions on the other side threatening the physical supply chains.
Exactly. And because global trade is facing these extreme, unpredictable headwinds, we're seeing a massive shift in how nations behave.
Right.
Governments are no longer waiting for the international order to stabilize. Instead, they are rapidly turning inward, passing massive domestic spending packages to secure their own baselines against these global shockwaves.
They're trying to build their own versions of Delta's refinery.
Precisely.
The sources outline three distinct, fascinating examples of this domestic fortification happening right now. So let's start with technology. Armenia is partnering with NVIDIA and Firebird on a $500 million AI supercomputing center.
That's a huge investment for them.
It is. They're deploying thousands of Blackwell GPUs, which are those highly specialized chips designed specifically to train massive AI models, and scaling the facility up to 100 megawatts. The stated goal here is to retain sovereign compute capacity.
They recognize that artificial intelligence is no longer just a software product. It is critical national infrastructure.
Right.
By building their own supercomputing center, Armenia ensures they aren't completely reliant on foreign tech monopolies if global tech supply chains fracture.
Then we see it in physical infrastructure. The Indian cabinet just approved the Jaipur Metro Phase 2 project. This is an investment of 13,038 crore rupees, which translates to roughly 1.5 billion US dollars, slated for completion by September 2031.
This is a massive commitment to domestic transit, and while it might just look like a local transportation project on paper, structurally, a robust subway system means millions of commuters are no longer relying on personal vehicles.
Which means less gas.
Exactly. That drastically cuts a city's reliance on imported oil. In a world where the Strait of Hormuz can be shut down overnight, a metro system suddenly becomes a geopolitical shield.
That makes perfect sense. And the third example is perhaps the most critical, and that's food security.
Yeah.
To protect their agriculture sector against energy-driven inflation, the Indian government approved a massive nutrient-based subsidy for the upcoming Kharif, or autumn planting season, specifically for phosphorus and potassium fertilizers.
Huh?
This is a 41,533 crore rupee package, roughly $5 billion. That is an increase of over $500 million from just last year. So what does this all mean? Are we witnessing the end of relying on global supply chains? Are these massive fertilizer subsidies and sovereign AI data centers essentially just economic bunkers being built against geopolitical volatility?
They really are, and we need to draw the causal line here to fully understand why this is happening.
Ah,
Fertilizer production is highly dependent on natural gas,
okay.
and natural gas prices are intimately tied to the volatility in the Middle East. If a war breaks out in the Persian Gulf, natural gas spikes.
Right.
If natural gas spikes, fertilizer becomes too expensive for farmers to buy. If farmers can't buy fertilizer, you don't have an autumn harvest, and suddenly you face a domestic food crisis.
So by heavily subsidizing the fertilizer right now, the Indian government is essentially severing that chain reaction.
Precisely. Whether it's ensuring food security through subsidized fertilizer in India or securing sovereign tech infrastructure in Armenia, governments are aggressively utilizing industrial policy. They are actively building these economic bunkers to shield their populations from external shocks.
Which brings us to what you need to watch for in the coming days as this highly volatile situation continues to unfold. Structurally, we're looking at three key indicators. First, the diplomacy in Islamabad. Will Friday's high-level talks actually hold? And can a fragile 88-minute deadline ceasefire be codified into a working agreement?
Right, that's crucial. Second, the actual physical movement of oil. We have to monitor whether commercial oil tankers truly resume safe passage through the Strait of Hormuz under Iranian military coordination.
Which still sounds wild to say.
It does. But if shipping companies refuse to enter the strait due to insurance risks, or if a single vessel is struck by a drone, the algorithmic relief rally we saw today will instantly reverse and the price spike will violently return.
And third, the economic tightrope. We need to watch if the AI-driven tech rally in the U.S. can continue to prop up global GDP numbers, or if the sheer weight of these regional conflicts and energy crises will begin to drag down the broader global economy, just like the World Bank is warning.
This entire landscape raises a fundamental concept that we really want to leave you to ponder as we wrap up today's analysis. If you look at Delta's refinery, Armenia's data center, and India's fertilizer subsidies, it becomes clear that the very definition of national security has fundamentally expanded.
Yet a profound paradigm shift.
It really is. It is no longer just about naval escorts and military hardware patrolling the Persian Gulf. In 2026, survival in a fragmented world means owning your own AI compute power. It means controlling your own oil refineries. It means subsidizing your own food supply to ensure your citizens can eat when global supply chains inevitably break down.
It goes right back to the paradox we started with. The algorithmic fire alarm might be temporarily switched off, but the smoke is absolutely still in the room.
The vulnerability hasn't gone anywhere.
So as you look at your own industry, your own business, or your own investments in this current climate, the vital question you have to ask yourself today is, where is our vulnerability and where is our refinery?